fixed exchange rates and currency crises. And then we're going to move on to part 3. And as I told you at the beginning, even though I have tried to sort of split the this open economy macro, also called international finance, into 2 parts, it's not straightforward to do that, because ultimately what we're looking at is economies that are open to the outside world, and you have open capital flows, and the economy is going to be reasonably small. And then it's about what kind of exchange rate system you're going to have. Are you going to go for fixed? Are you going to go for flexible? But ultimately, the mechanics of what happens to the economy when there's shock A or shock B, what should be the policy responses and so on, what happens when you're part of the bigger market, those mechanics are actually going to be quite similar. So even though you will have sort of questions in your exam that will reflect the various parts, so you could have 4 questions on part A, the stuff that I will cover by next. I will have covered by next week. Anyone that is able to draw from the other parts is potentially always going to be able to write a better essay. So bear that in mind. I think, in my view, it does make sense to understand everything. And it's only when you specialise and you say, well, I want to go first, and I want to read all the readings of a particular topic, that you would go into more depth. But it's really good idea to have a broad sense of the whole topic. Yeah? Okay, so let's go back to currency crisis. So I talked about first generation, then I talked about second generation, and I mentioned the ERM crisis, in particular the pound sterling crisis, is a good example of that. And remember, the crucial characteristic of second generation models is this idea that ultimately you have several objectives. For example, you want to have low inflation, but you also want to keep output and unemployment at the right levels. And in some cases, the pressure on the pressure on the economy is just too strong, and you prefer to abandon your commitment to the fixed exchange rate rather than carrying on with ever higher interest rates and ever greater recession. So this conflict of objectives is absolutely key. Now, so we had 2 generations of models before the East Asian crisis, before also the so-called Mexican or tequila crisis in Mexico in 1994. And of course, because those crises seemed to be of a different kind, we had to think about other sorts of problems that would lead to crisis. And that's what third generation models do. And of course, it's rather general. There's going to be all sorts of crises that are covered by these third generation models. The East Asian crisis of 1997 and 1998 were definitely one of the main triggers for this new generation of models. And what I did towards the end of last week, if you remember, was to remind you some basic stuff about balance of payments. So this idea that you have all these flows taking place between the country and the rest of the world, ROW, and if you have a totally flexible exchange rate, what we also call a clean float, then the sum of your current account, which is mostly the balance of trade in goods and services, plus the capital account, must be equal to 0. And so, not too surprisingly, if you are the UK or the US and you consistently produce less than you consume, in other words, if you run a current account deficit every single year, then you must have a capital account surplus. So people must be willing to buy your assets, and that's what has been happening for decades in the UK and in the US. However, once you have a fixed exchange rate system, the demand and supply for your currency do not have to be equal. And it's very possible to have both a current account surplus and a capital account surplus. And of course, that has been the case for China for many years. What this means effectively is that if the central bank is committed to some kind of fixed parity, then the central bank will be accumulating so-called foreign exchange reserves. And equally, it's possible for a while, but of course the speculators will be out there, for a while to run a capital account deficit and a current account deficit as well. And the way you compensate for these two is by reducing your foreign exchange reserves. So the crucial thing is that balance of payments has to be equal to zero. Whether you have official foreign exchange interventions only depends on whether you have a flexible or a fixed exchange rate system. Now, the East Asian economies were all more or less committed to fixed exchange rates, and the crises were deep, and in part because they were not just about an attack on the currency, they happened with debt crises and banking crises as well, and that's why we're going to look at this into a little bit more detail. By the way, the next topic, which I will start halfway through this lecture, optimum currency areas, and then an application to this when we look at the euro, is going to have these various elements. Why has Greece been attacked in the last 5 years by markets? It's not because of an attack on the currency, because Greece uses the euro. It's because there are other issues, there are debt crises, there are banking crises, and that's all we need for the speculators to kind of sense that they can make a profit by buying and selling particular types of assets. And so Greece has been attacked, and so has Portugal, Spain, Ireland, and so on. So I'll come back to this later on. So one of the things that these crises have, the common element of many of these crises, is this aspect of self-fulfilling prophecies or mechanisms. And here's an example of that when the trigger is a reassessment of the credit riskiness of a particular country. And this, again, applies to Greece. Currently, interest rates on Greek bonds have again risen substantially in the last few months, and they're now at 8%, way higher than interest rates on German bonds, for example. So, you have these international investors that have been lending money to your country, and of course they're not charities, so they want to, they're lending because they think they're getting greater returns, maybe because we're an emerging market economy. But then they reassess the risk and say, well, maybe we were a bit too optimistic, maybe this country is not the El Dorado, maybe that we're not going to have that many really profitable investments. And so they kind of stop that capital flow, and if it's very abrupt, we call this a sudden stop. So capital that was flowing in just dries, and you get a reversal. And so that is called the capital flight. So people that were lending and carried on lending, for example, rolling over the debt, they say now, this time, they say, actually, I'm not renewing your debt, you need to pay me in full. And so, of course, this means that the country is now facing a big capital account deficit, right? So the capital account becomes large and negative. And if we go back to the initial trigger of this, it was just this reassessment. So it was all about these international investors not being quite sure that it was a good idea to invest so much in that country. So that was a trigger. But now what we're going to see is that this is going to be self-fulfilling. They were sort of right in being worried. And why? Well, if you have a fixed exchange rate regime, then you're going to have to, of course, to cope with this outflow of capital by selling foreign exchange reserves. So the basic idea, remember, is that now they want their capital that they lent in their various currencies, and so that they want the dollars, they want the euros, and so on. You have to make sure that you're willing to supply the difference, and you keep on selling as a central bank those foreign exchange reserves. But of course, as we know, this cannot go on forever. So starts this expectation that sooner or later the central bank and the government as a whole is going to abandon this peg. Because they're called soft pegs in the sense that people are committed. But, you don't go to jail if you suddenly say, sorry guys, we have to devalue. So they're soft pegs, and investors know this. So they start speculating about the potential devaluation of the currency. Now, if you remember our interest parity conditions, so our basic condition is equilibrium in the foreign exchange market. So we have this interest rate in a country that has now been taxed, this emerging market say, this interest rate of the anti-country hasn't changed. And if we ignore sort of the risk agreement that might be zero and constant, then what we're now seeing is that these guys now attribute a positive probability to this expected appreciation or depreciation term. So if people are committed to ST being equal to S1, but investors know that this is not set in stone, they will start speculating about this becoming positive. And so they expect a devaluation, and of course, as you can see, this means that they will only be willing to invest in the emerging economies if they are compensated for this expected devaluation by getting a higher return than the active country. So if this country is paying interest rates of 4% on government bonds, and as you know, that is a benchmark rate and then triggers to all the other rates of interest in the economy, and if this expectation is now 5%, you will have, as an emerging market economy, you're now borrowing, rather than at 4%, you're borrowing at 5%. And of course, that makes everything more expensive. And so, it may well be that the people that have borrowed money from banks are going to find this increase in interest rates too high, and so they will indeed be defaulting. And so some companies will default. The banks that have lent to these companies will see that the value of their assets, because of the defaults, is now substantially lower than they thought they were, so they can also go bust. And so as you can see, this is actually going to be self-fulfilling. There's going to be, the financial markets will not be working as well as before. There's going to be lots of companies going bust, making, therefore, lower profits, the banks as well. And so economic activity that will indeed fall. And of course, every time economic activity falls, this has an impact on government expenditure and taxation, because all of our systems, even in emerging market economies, have so-called automatic stabilizers. So even in a country such as China that doesn't have a great welfare state, it's still the case that you're going to be entitled to some kind of unemployment benefits. So of course, if the economy enters lower growth and unemployment rises, the government will have to spend more on those transfers. And equally, because the government is now collecting fewer taxes from individuals and households as well as firms, the budget is moving in the wrong direction, into the red. So this initial expectation that maybe this country is not going to give us very high returns, or as high returns as we thought it would, is going to be self-fulfilling because of these mechanisms. And unfortunately, this applies to many of these banking and financial, banking and debt crises. There's a big element of self-fulfilling prophecies.